Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's just dive right in. Our focus today is SLS Life Sciences Group, symbol SLS, currently trading in a highly volatile range between $3 and $4 as of early January 2026. And this isn't your typical small cap biotech churn. I mean, this stock is an absolute powder keg. It's just primed for a violent move depending on the binary results of the Phase 3 Regal trial.
The market tension is palpable. You've got roughly 40.5 million shares held short. That's nearly 29% of the free float. And the annual cost to borrow for those shorts has just soared to an insane 534%. The pressure is just extreme.
It is. It's extreme. So the central question for us is this. Does this profoundly slow event accumulation we're seeing in the Regal trial, which is testing their asset, galin-pipepimute S, or GPS, does that represent a meaningful clinical survival signal? Or is the stock's volatility really just distorted by market mechanics and, crippling dilution? I'm taking the stance that this data anomaly strongly suggests GPS is working, implying a severely discounted value that could see the stock re-rate towards $7 or $8.
And I come at it from a different angle. While the technical setup is undoubtedly extreme, I agree, a 534% annualized CTB is almost unheard of. That very tension makes SLS less of an investment and more of a leveraged volatility instrument. I'm going to argue that regardless of any clinical optimism, the company's precarious financial architecture, its massive warrant overhang, and its history of dilution, it all creates a structural ceiling on the stock. And, maybe more importantly, the clinical risk of control arm drift threatens to move the statistical goalposts so high that any benefit could be rendered irrelevant.
Okay, well, my bull thesis is built squarely on the objective data that's streaming out of the Phase 3 Regal trial. This trial is studying acute myeloid leukemia patients in their second complete remission, CR2. This is, a dismal patient population. Treatment options are very limited. Outcomes are historically tragic. So the trial was designed to hit its final analysis after 80 death events. As of the end of 2025, we'd only recorded 72. And that right there, that is the critical factor. We are seeing an unusually stark deceleration in event accumulation. Historically, the expected median overall survival for these CR2 AML patients is somewhere between 6 to 8 months. But the pooled median survival for all patients in this trial has extended to nearly twofold longer than that baseline. This statistical anomaly is, in my view, it's just too stark to be accidental. It strongly implies the GPS arm is driving a profound survival benefit. And the science, the mechanism of action, it supports this. GPS targets the WT1 antigen, which the NCI ranks as a top priority target. And it uses these specialized heteroclitic peptides to eliminate minimal residual disease. The science aligns perfectly with the data.
That's a compelling argument based on the science, I'll grant you that. But I'm not convinced because we first have to address the foundation of those historical baselines you mentioned, and frankly, the company's ability to even survive long enough to capitalize on an outcome. The company operates in a precarious financial state. They reported only, $44.3 million in cash as of Q3 2025, while burning through nearly $7 million every quarter. This forces their hand toward dilutive financing. More critically, their capital structure is severely strained. Over the last few years, the share count has quadrupled, jumping from roughly 32 million to 125 million shares, and that's largely due to a massive warrant overhang. This history, it just puts a structural ceiling on any appreciation because the warrant holders are always incentivized to sell at the first sign of a rally. And clinically, all the optimism about the extended survival, it's speculative. We haven't unblinded the arms. I maintain that the greatest threat is what we call control arm drift, where the best available therapy arm simply outperforms those old benchmarks. If the control arm has silently performed far better than that 6 to 8 month historical figure, then GPS faces a much, much higher statistical hurdle.
Okay, let's dive deeper into that. The interpretation of this survival anomaly versus the risk of control arm drift. You're relying heavily on the idea that this historical 6 to 8 month baseline is outdated.
Exactly. And we have a perfect precedent for this danger in AML. Just consider the Quasar AML 001 trial. Now, while that trial focused on CR1 patients, the crucial takeaway was that the placebo arm achieved a median overall survival of 14.8 months. That figure was shockingly high. I mean, it far exceeded expectations, and it set an incredibly tough bar for the investigational drug. It proves the danger of relying on these low, outdated historical benchmarks. So if the BAT arm in Regal has, due to better supportive care, achieved a median OS of, say, 12 or even 14 months, then the benefit GPS provides might be statistically negligible. The trial could fail even if GPS is clinically active. The difference between 14 months and 16 months is just not the same as a difference between 8 months and 16 months, statistically.
I see the point, but I think that's comparing apples and oranges across remission states. The Quasar trial involved patients in their first remission, a population that has already responded favorably to chemo. Regal is targeting CR2 patients. These are the ones who relapsed quickly. They're critically different, far more difficult to treat. And historical data from, world-leading centers like MD Anderson, it confirms that CR2 patients typically have these dismal outcomes, often below 10 months. We're talking about patients where the clock just runs out very, very quickly. So to see the pooled median survival extend so significantly, it strongly implies that one of the arms, the GPS arm, is drastically skewing the average. And, we have to place immense weight on the Independent Data Monitoring Committee, the IDMC.
Right.
They're the objective body reviewing the unblinded data. They've repeatedly recommended the trial continue without modification. Their mandate requires them to halt a trial for futility. The fact that they keep saying continue is a strong objective signal that GPS is providing a benefit over the control group. We might not know the hazard ratio yet, but we absolutely know it's performing better than useless.
Okay, ruling out catastrophic futility is not the same as guaranteeing success that justifies a multi-hundred-million-dollar valuation. I'll concede the IDMC's recommendation is powerful evidence against complete failure, but that still leaves a massive gap. Let's pivot to the structural element, though, the fight between market mechanics and this dilution engine. You focus heavily on the short squeeze potential, and mathematically, yes, the high short interest and that staggering 534% borrowing cost create a lot of pressure.
It's not just pressure. It creates a mechanism for extreme upside when the news hits. We have 40.5 million shares short. These shorts are paying a devastating price every single day, and the options market reinforces this pressure cooker. The put-call ratio is extremely low, 0.04. This tells you retail is hyper-bullish, buying massive amounts of calls. So the dealers and market makers who sold those calls, they are now essentially short volatility. If the stock ticks up even $1 on good news, they are instantly forced to hedge by buying the underlying stock to stay delta neutral. This creates a secondary force, again a squeeze, that combines with the short covering. I mean, the technical setup is perfectly primed to send this stock vertical.
I'm just not convinced by that because the dilution engine acts as a hard structural cap on any appreciation. It prevents the momentum you need for a true squeeze. You can't just ignore the warrant overhang, the financial mechanism that constantly sells into strength. Warrant holders have the right to buy stock at a fixed low price and instantly sell it. They're sitting on easy, risk-free money. So the moment the stock jumps to, say, $5 after a data release, those warrant holders are going to instantly exercise and dump millions of shares right into that rally. This influx of selling liquidity, potentially $29.1 million worth, it just acts as a structural break. It explains why the share count has quadrupled, and it prevents the kind of moonshot retail investors are hoping for.
That dilution is an unfortunate reality of financing pre-revenue biotechs. I get that. But it doesn't diminish the efficacy of the underlying science, which brings us to the third point, the viability of the WT1 peptide vaccine modality itself.
And that is a huge point, because the broader scientific community applies a severe skepticism penalty to peptide vaccines in oncology. And that skepticism is baked into this low valuation. The modality is historically littered with failure. So why should the market believe GPS is the exception? We have seen countless peptide vaccines just fail to generate robust or durable immune responses in late-stage trials. The market is pricing this in.
But the scientific premise of GPS is designed precisely to overcome those historical shortcomings. It uses advanced heteroclitic engineering. See, past peptide vaccines failed because the native peptides had very low binding affinity to the patient's MHC molecules. It led to a weak T-cell response. GPS is different. It chemically modifies 4 peptides to significantly enhance their binding affinity. Think of it like a poorly cut key versus a master key. The heteroclitic peptide is engineered to force a broad and potent activation of both CD4+ helper and CD8+ killer T cells. These activated T cells then cross-react with the native WT1 on the leukemia cells. It's an engineered efficacy, targeting a high-priority antigen. It's a next-generation approach.
Differentiation is one thing, but realizing that success in a phase 3 setting is another. And even if the science is robust, we can't ignore the persistent governance penalty that suppresses its valuation. Which brings us to the final point, valuation and governance. You see this enormous upside based on pure valuation.
Absolutely. If the Regal trial is successful, the market has to re-rate the company. The risk profile fundamentally changes. I mean, look at Kura Oncology. They're developing a menin inhibitor, also in phase 3, and they trade near a $900 million market cap. A successful Regal readout should re-rate SLS to at least Kura's level, which implies a fundamental undervaluation of 300% to 400% from here. That's a target of $7 to $8 per share.
And I agree, the clinical upside potentially exists, but the company will always trade at a significant discount, probably 20 to 30% lower than its peers because of the investability gap. The governance penalty is real. The CEO's legacy at Galena Biopharma and the subsequent regulatory settlements, even though they were resolved years ago, they've left a permanent stain. Many major blue-chip institutional funds just have zero tolerance for management teams with a history linked to SEC investigations. This explains why institutional ownership is so low, right? It's hovering around only 23%. That lack of major institutional conviction is the structural cap I've been talking about. The stock is driven by speculative retail sentiment, not stable institutional buying, and that will permanently cap the valuation. You can't get to a stable $7 or $8 without that base.
But that skepticism is precisely what creates the incredible risk-reward asymmetry. The key is the asset itself. The GPS asset has survived multiple corporate structures. The science has been repeatedly validated by independent bodies like the IDMC. For those who have done the deep due diligence, this low institutional ownership is the opportunity. The stock is fundamentally cheap because of historical concerns, not current clinical performance. So, to summarize my position, the decelerating event accumulation in the Reg-Ale trial is an objective, measurable signal that points toward a profound survival benefit from GPS in a patient population that desperately needs it. The high short interest simply amplifies the potential return. If the data confirms efficacy, the squeeze potential is enormous, suggesting the risk-reward asymmetry overwhelmingly favors the bull case.
And my conclusion remains anchored in a different reality. The stock's destiny is less about whether GPS works slightly and more about whether it works enough to overcome the statistical hurdle set by a control arm that may have drifted significantly upward. And furthermore, any clinical success will be immediately challenged by the company's capital structure. The persistent dilution engine and the warrant overhang act as a structural break. This stock, given its volatility and financial issues, is fundamentally suited only for highly speculative capital betting on a pure binary event.
The complexity here, with the severe financial mechanics layered on top of a highly sophisticated clinical study, it just means we have to wait for the unblinded data after that 80th event is recorded, which we expect in early to mid-2026. Until then, both the science and the structural limitations are potent forces.
The ultimate arbiter will be the final hazard ratio. It will be fascinating to see whether the promise of the science or the limitations of the structure wins out in the end.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.